Hey, real estate investors, taxes giving you a headache? If you own rental properties, you need to understand passive activity loss, PAL rules. These rules can be a game changer for your tax bill, but they're also a source of major confusion. In this video, we're breaking it down in simple terms and revealing how to maximize your tax deductions. Let's dive in. What is passive activity? The IRS divides income into two categories, active and passive. Active income is what you earn from working, like your salary or business profits. Passive income is from investments where you're not materially involved, like rental properties. Here's the key. Losses from passive activities can only offset passive income. Passive activity loss rules are designed to prevent people from using rental losses to offset their regular income and lower their tax bill. Here's how it works. Offsetting passive income. If you have multiple rental properties, you can use losses from one to offset income from another. The $25,000 exception. If you actively participate in your rental property, meet certain criteria, you might be able to deduct up to $25,000 in losses against your other income. But beware, this exception phases out as your income increases. Carry forward losses. If your passive losses exceed your passive income, you can carry them forward to future years and deduct them when you have passive income to offset. Here's a potential workaround. If you're a real estate professional, your rental losses might not be considered passive, but it's tough to qualify. You need to meet strict criteria, like spending more than 750 hours a year on real estate activities and more time on real estate than any other job. Even with passive activity loss limitations, there are ways to maximize your tax benefits. Depreciation, one of the biggest tax breaks for rental property owners. Cost segregation study accelerates depreciation deductions for even bigger savings. Careful record keeping. Meticulously track all income and expenses. Consult a tax pro. A qualified professional can help you navigate these complex rules. Don't let passive activity loss rules scare you away from real estate investing. By understanding how they work, you can strategically plan to minimize your tax bill and maximize your profits. Want more tips on real estate investing and tax strategies? Hit that subscribe button for a wealth of information to help you reach your financial goals. Don't forget to like and comment if this video was helpful.